typically when we think of venture capital, you're thinking about a structured fund where you've got professional managers, they're called general partners or GPs, and then you've got limited partners, which are either high net worth individuals or corporates or family offices or institutional investors. And so they are driven by the idea that they're going to invest in things that can scale quickly where they can get a 10 times return on them. And so they'll tend to have an investment thesis that's targeted at a sector and a stage and some very specific things. So they'll have a theme against which they invest. The really good venture capital investors kind of follow the Warren Buffett rule. If they can't add value and it's not something they fully understand, they typically won't invest.
Yeah.
And so that doesn't always mean tech. That can mean thematically somebody in the venture space might say, we're really interested in home services companies. And why? Well, maybe we're interested in them because those home services offerings are not going to change or be eliminated by AI, as an example.
Yeah.
And so it really just depends on the theme that you pick as a venture capital investor.
This is the Startup Junkies podcast. Hello, ladies and gentlemen. Welcome to another episode of the Startup Junkies podcast. Thank you for tuning in, however and wherever you're tuning in from. My name is Daniel Koonce, and I'm joined today by my co-host, Miss Grace Gill. Grace, how you doing today?
I'm doing well. Thanks for having me on, Daniel.
Thanks for coming on. It's been a minute since you've been on the official Startup Junkies podcast.
Yeah, I'm excited. Knock some cobwebs off.
Yeah, it's good to have you back. Well, today we have a special episode because our guest usually is a host, but Mr. Jeff Amerine. Jeff, how are you doing today?
I'm great. Glad to be here.
Yeah.
Glad to be back. It's been a minute.
It's been a minute. Glad to have you back. Well, today's episode, we are talking about something a little different. We're not necessarily getting into the founder story, but we're going to be talking about a topic, and that's going to be funding strategies for entrepreneurs. So, Jeff, we'll kick it off and just ask you, what funding strategies are out there for small business owners?
Yeah, there's a couple of ways of going about it, and it really depends on the goals and objectives for the founders, but it falls into two categories typically. It's either going to be debt finance, where you're going to a bank or a microlender or a community development institute that will have those sorts of resources, or it's equity based, where somebody's taking shares in the company. And there's a third category we talk about sometimes, which is non-dilutive funding. So those are typically federal grants that you can get if you've got something that's intellectual property intensive that some federal agency would care something about. Those are sort of three big categories. It really depends on what you're trying to achieve.
Mm-hmm. Where do you usually send people who are starting their first business, for example? Which one of those should they go to?
They'll come in to our process and we'll go through a bit of a listening session, a little bit of triage, and we'll say, I'll ask a question. Is this an opportunity where you're going to lose a market opportunity if you don't go fast? And if they need to go really fast, then a lot of times we'll say, well, then you probably need to think about venture scale, which means the traditional go to friends and family, and sometimes we include fools in that, the triple F round. Then you think about angels, and then you think about venture capital. There's a progression. So, I mean, a lot of times come out of your own wallet, bootstrap, friends and family and fools, angels, and then venture. If they don't have a market opportunity that you have to go fast and they're going to miss, and sometimes what we'll say is just bootstrap. Figure out a way to structure your deal so that where you can finance a lot of it based on your customer terms. There's no great glory in having to raise outside capital. It's really a difficult process, and so if you don't have to, if you can build a business where you can just go get contracts or solve a problem or start in a professional services basis, a lot of times we'll advise them to do that. So it's a triage that we go through to find out the nature of what they're trying to do, and then we'll try to fit them with the best strategy based on that.
Mm-hmm. You said this term, bootstrapping. For any of our audience out there, what is that?
That just means working out of your own wallet. Mm-hmm. So that's essentially the sweat equity deal, where you get together a group of people that can all work on aspects of the business, and maybe they're not paying themselves, or they're all contributing a little bit individually. You're not raising outside capital. That's typically what we mean. Mm-hmm. And you get as far as you can get doing that before you talk to any outsiders.
Yeah.
I think the speed of opportunity is a really good way to differentiate the difference if do you need to go down the venture capital route or not. But to be even more specific, obviously my background is working with a lot of tech ventures, so venture capital is always in the conversation somewhere. But is venture capital reserved solely for tech ventures?
No.
Then tell us, like, kind of what other, outside of just building tech, can businesses approach venture capital?
Yeah, again, so it'd be good to kind of qualify what we mean by venture capital and angel capital and the whole bit. Typically, when we think of venture capital, you're thinking about a structured fund where you've got professional managers, they're called general partners or GPs, and then you've got limited partners, which are either high net worth individuals or corporates or family offices or institutional investors. And so they are driven by the idea that they're going to invest in things that can scale quickly where they can get a 10 times return on their money. And so they'll tend to have an investment thesis that's targeted at a sector and at a stage and some very specific things. So they'll have a theme against which they invest. The really good venture capital investors kind of follow the Warren Buffett rule. If they can't add value and it's not something they fully understand, they typically won't invest.
Yeah.
And so that doesn't always mean tech. That can mean thematically, somebody in the venture space might say, we're really interested in home services companies. And why? Well, maybe we're interested in them because those home services offerings are not going to change or be eliminated by AI, as an example.
Yeah.
And so it really just depends on the theme that you pick as a venture capital investor. And the one thing I would say about that is sometimes we get captivated in the mythology around the whole game as won or lost based on raising VC funding. Only about 0.6% of all U.S. businesses ever raise venture capital.
Wow.
Far easier if you wanted to go to Harvard Business School for your master's or your PhD to get in there than to raise. It's hard to raise. And so what does that mean? Does that mean only that small percentage can ever build great companies? Not so much. It means there are alternatives where you can go to angel investors or other routes and never necessarily have to raise from a venture capital fund.
Yeah, that's awesome. And I think I'm jumping kind of right into it, but really to that point of that, venture capital has a really high bar. And I have seen, even just in the short time that I've been kind of in this world, that it's only become higher. Like, how do you even break in? How do you really sell and show a validated reason to get venture capital funding? I feel that it's moved even more to now folks have to have certain traction and certain revenue markers even higher than maybe before. So, from your perspective, what is a good indicator to a founder that they are ready to start dedicating time to the fundraising process? Because as you just mentioned, it's a difficult thing to do and it's a full-time job. And so in its own right? Like, it takes a lot of energy and effort outside of what may be needed from business operations standpoint. So what are some of those indicators that a founder could be ready to look down that path?
Yeah. It's a really good question. So I would say, and again, think about the progression. So if you're a founder, you want to validate as much as you can validate product market fit on your own first. How do I have demand indicators that say that I've got a real business and that I've got some evidence that somebody would pay to have the problem solved, the opportunity that I'm talking about, they'd pay for it, right? And what evidence do I have of that? At that point, you might say, well, I'm going to go to the people that are going to make an investment based on their trust in me, friends and family, those people that are close to you. You go a little bit farther, you've de-risked a little bit more, you've now got something to where you've maybe got a couple $100,000 in annual revenues or annual recurring revenue if it's subscription-based. Then you could say, well, maybe I've got a good enough story to actually go to an organized angel group or fund. These can be individuals, they can be structured as an angel fund, an angel group. And then based on that, you achieve a few more things and you say, well, now I'm really ready for seed stage or later, and I'm at that $1 million to $4 million annual recurring revenue or revenue threshold. Then it starts to become interesting because, as you said, most venture capital groups are not doing pre-revenue, pre-seed stuff. There are a few, and there's some pretty good ones that do, but they're few and far between, and they're very selective. And so most of them are going to be, where's the proof? Where's the evidence? And so you might say, why have they done that? The venture firms have done that because they also have a fundraising problem that's exceedingly difficult, where they have to go to the potential limited partners, high net worth individuals, family offices, public institutions, and say, this is a good asset class to invest in, and here's why. And that's based on your own past performance. And that's gotten more and more difficult. Why? Because there's lots of competition between asset classes. When you've got a public market that's been going like crazy, and somebody looks at that and it says it's essentially zero risk, and there's all kinds of public information, and you've got real estate, particularly in this area, that's doing well, people are going to look at our asset class and say, why would I do that? Yeah. Or if I do that, I'm only going to allocate a small percentage of my net worth or my portfolio to that. So it's gotten more and more difficult, which means from a founder standpoint, you've got to do something that's highly differentiated, and you've got to be great at executing on your business model. There is very little tolerance for things that my co-general partners would call capital incinerators. If you haven't, you think of Brett in particular would say that, but if you think about it, if you look at how much a venture has raised and what they did with it and what they learned, if it doesn't look like they took that and added multiples to their revenues or really learned some very specific things or advanced the product, if they weren't capital efficient, they're probably going to have a difficult time raising money in the next round. Long-winded.
Yeah, but it makes sense. And I think, as we work with founders, when they kind of understand that, who sits on the other side of the table, because founders will get frustrated with VCs very quickly. But when you think about kind of what sits on the other side of the table, it makes sense. And that statistic that like less than 1% even raise venture capital, I'm going to keep that in my back pocket because I didn't know that. That's interesting.
Yeah, that's a good stat. Right?
And to make it maybe more real for the audience and for you all as well, in a given year, a typical venture fund will see top of funnel 1,000 deals.
Yeah.
They'll get to the point where they might take calls from 100, right? And a lot of times, our inboxes are inundated with stuff we're never going to look at. I'm sorry for the audience. We're never going to look at it. If you weren't referred by somebody you know or somebody we trust, we're probably not going to do it. So of that 100 that you actually take calls from, there might be 25 or 30 where you say, man, this looked pretty close. Let's take a follow-up call. Let's look at their data room. Let's get into due diligence. And then from that, there's maybe 3 or 4 you actually invest in.
Yeah.
So 3 or 4 out of 1,000 starting top of funnel.
Yeah. From the founder's perspective, we just talked about when is that time when they're ready.
Yeah.
What's that next step look like where maybe they can't just reach out to you or they don't know anybody who's a contact at a VC? How do they go and find that funding?
Yeah, this is where they've got to build that personal network. So they need people that are close to them that have either raised money or know someone. They can reach out to portfolio companies that are within the portfolio of some of the ventures they want to get to and try to build relationships. They can go to the conferences, go to things like Invest Midwest and Onward FX we have here and all that kind of stuff. It's really about building relationships and trust. And when you do get an opportunity to pitch, realize that most of the answers you're going to get are no, but you want to build relationships with people. If you're too early or whatever, it's okay for the ask to be, hey, who can you direct me to where we'd be a better fit, that kind of thing. And I would also say you improve your odds a lot if, as a founder, you do your research on the front end to say, I'm not just going to shotgun blast our story out to everybody that might be a fit. I'm going to be very targeted and just pick funds where I know they've got coverage over the space we're in. So you got to do as much research on the fund as they're going to do on you on the front end.
Yeah, being in an accelerator, working accelerator programs, I feel like our cohort companies, like that's like the biggest value they get as being in a cohort is them being like, oh, well, we have this great investor, we'll introduce you.
Exactly.
And so even looking at, second degree connections that then can start to build this network.
That's really the only way it gets done.
Yeah,
it's a referral. It's like,
exactly.
oh, I invested in that group and I trust them and they sent somebody to me.
Yeah.
Yep.
Yeah, when it comes, to pitching to an investor, you have to have almost a flawless pitch, right? If you're only picking 3 or 4 out of that 1,000.
And that's table stakes, by the way.
Yeah.
I mean, that's just like the initial rite of passage. So the choreography and all that's got to be good. That's the sort of sizzle. The stake and understanding what they really know comes in the Q&A and in the diligence around their data room. But keep going.
That's perfect. What are some of those fundraising mistakes you see founders make?
Yeah. Where do I begin?
How much time do we have?
I would say one is shotgunning out to everybody in the universe, establishing too high a valuation, assuming that if you're anywhere other than Silicon Valley, you can justify a Silicon Valley-based valuation. That tends to turn people off. Things like progressive disclosure or shading the truth or putting a bunch of logos on slides where you just had one conversation with them, but they're not really customers. It's, there's this thing that came out of Silicon Valley that says fake it until you can make it, and that is just total BS. Mm-hmm. That is the way to ruin everything. You might get away with it for a while, and then you become Elizabeth Holmes and you're in jail.
Right.
So you just want to be brutally honest with it. You need to be buttoned up and you need to have your stuff together, but be brutally honest, because good VCs are like forensic investigators. Yeah. And it's like, you just caught you at the airport and you might be smuggling drugs and a body cavity search is coming. So get ready. And if you got something hidden, we're going to find it. Yeah, so just, you got to be ready for
You can
all
sniff out the fakers.
Yeah, absolutely.
Well, especially I feel like when you probably see so much across the board, and if you're looking at a certain niche, whatever that is, I mean, hopefully that some of this stuff, it's not foreign to you.
The Startup Junkies podcast is brought to you in part by Arise. Arise helps Arkansas tech and tech-enabled startups grow with no-cost coaching, capital navigation, and expert connections so founders can scale faster. Learn more at arisearkansas.org.
But on kind of a more technical side, and this is even maybe taking a step backwards from institutional.
Sure.
Talk to us about the difference between convertible notes and safes. Because sometimes when I meet with early stage founders and they're starting to think about kind of this fundraising road, I'm like, well, first, educate yourself on at least the basics of what it would even look like. Yep. And so when you start to have these conversations and you start to network, you can speak about it and you know where you're trying to go with it. And
this is hard, particularly for first-time founders and entrepreneurs, is there's a whole language and jargon, and you got to learn it. You got to learn it to where it feels like you're a pro in understanding it. Fantastic book written by Brad Feld called Venture Deals. There's also a site called Venture Deals, venturedeals.com. We could probably put that in the show notes. But read that cover to cover. It gives very specific and understandable examples of all of the terms of art associated with venture and early stage capital raising. And you got to know that. And I would also say mine, the Angel Capital Association sites, National Venture Capital Association, lots of good information so that you can become an expert on something that no founder really wants to be an expert at, but you gotta know how to do it. The other thing is having in your back pocket early on a good venture capital aware attorney, somebody that's done a lot of transactions, and there's a handful in the state. You have to have somebody like that too. So to your point, price rounds and equity, in other words, putting money out for shares at some price is the classic way of doing it. And typically that manifests in the form of preferred shares. And what a preferred share is, that means that you're going to get paid first before the founders and the common shareholders, and you're going to convert on some kind of basis. That's classic investing. About 20 years ago, the folks in Silicon Valley are like, pre-revenue, early revenue, it's impossible to use conventional financial formulas to come up with what the valuation ought to be. Because you can do a 5-year forecast, and it's a total work of fiction. And you do net present value, discounted flat cash flows, and it looks like you're going to be worth millions, and it's all crap. Mm-hmm. It's no good. And so some really smart folks out there, Paul Graham and some of that crew at Y Combinator said, we need to have something that is equity-like, but not really equity. And so they originally invented this thing called a convertible note. And it looks like a loan, a promissory note. It will typically have a coupon rate of simple interest that accumulates over the period of the note. And it will have a discount rate, which means that when that note converts to equity at some future milestone, you're going to get your shares at a discount to what the later investors will get. Or it can have, and sometimes it has both, a valuation cap. Yeah. So those are kind of the parameters. But it looks like a note. It's a simple document, et cetera. And then the folks on the West Coast said, well, that's not simple enough. And so they came up with what's called a SAFE agreement, which is a simple agreement for equity. I always say a simple agreement for equity later. And it looks just like a convertible note, except there's no interest rate associated with it. So it's everything a convertible note is without the interest rate. You might say, well, why did that matter? Well, evidently, and this is why tax lawyers and accountants exist, I suppose. Somebody said, well, the one problem with a convertible note from the investor side is the IRS can believe that you're actually getting income from that simple interest that's accumulating on your investment, even though it's not being paid out. It's just being accrued. And so you could have taxable liability. And they said, let's just get rid of that, eliminate that, and that's where the SAFE agreement came from. So the thing as a startup founder to be ready for is be ready with any of the three of those. If you think that there's some question that you'd be able to come up with a realistic valuation that's fair to you and fair to the investors, then a SAFE or convertible note is the way to go. It allows you to buy 1 to 2 years before you do that qualifying price round to prove some things, to de-risk the venture. That's where all that stuff came from.
Yeah, and you'd say that that's why kind of they say that like SAFEs are founder friendly.
They are, and it's okay. You know, from an investor standpoint, you still have the controls in that what we require typically is both a discount rate and a valuation cap, not one or the other, because there's scenarios where either one could be in your best interest as the investor. But yeah, I think it's shorter document too. It's not a whole subscription document. It can be very short. Yeah.
Well, I got one more question for you. It's very elementary. I feel like this should have been asked at the very beginning. But just to break it down for us, why do a bunch of companies that need to scale, why do they need money? What are they spending it on?
Yeah, so it's a good question, and I'll tell you what, it's a changing question. Over one of the things that I've witnessed over the ridiculously long time that I've been involved with all this is, in the early days, anything in the technical realm was very capitally intensive. It was super expensive to do anything. You had to have the people, and you had to have the infrastructure and computing and all that kind of stuff, very expensive. Now, quite honestly, with AI and with the ability to do stuff, it's gotten easier and easier to stand up companies without investing, without having as much capital expense associated with it, without the operating expense being as high, and without it taking as long to get to market. So now I would challenge every new venture to say, given AI, given agentic AI, given all these platforms and tools, what can you do and how far can you go without ever thinking about raising? Until you absolutely positively have to spend money on something quickly in order to not miss a market opportunity. So that equation is not static. It's constantly changing now. And I think if you go on any of the online forums, you start to read, people are like, yeah, rather than needing 10 software developers, I can have one chief architect and one business-oriented founder, and we can build everything we need using Claude Code and the other tools that are out there. But oftentimes that's what it is. They're doing two things. If they're smart, they're building product and they're building the marketing and sales. That's really the only thing you ought to be spending money on early on. You're building the product or the service that you want to launch, and then you're spending money on the marketing activities in order to sell, market and sell. And that's it. If you're spending money on other stuff, you're probably spending money on wrong things.
Yeah.
That's what they need it for typically.
Yeah, that's a great answer.
Yeah, I would say, and I think that like kind of brings up one more point. We've talked a lot, about about venture capital, but a lot of times people talk about strategic investors.
Sure.
So one of the reasons as well, and it's usually probably a secondary reason, but I'd be curious to hear your thoughts around, folks that are go get certain capital that comes with that strategic guidance. A lot of VCs claim that they have strategic guidance. So what are your thoughts around that and kind of some advice for founders when it comes to strategics?
Super good question. And a couple ways, I'll kind of bifurcate it a little bit. There are strategics that are sometimes what you'd call corporate VCs that have very specific strategic interests, like it might be a healthcare system that has an investment arm or a large company that has an investment arm. Tyson Ventures, good example. They've got an agenda. They're going to go buy things that either at some point they want to acquire outright or that have some strategic value to them. The other thing, and you'll hear us in meetings advise companies to do this, is what I call subject matter strategic investors. So this can be somewhere after Friends, Family, and Fools and bootstrapping, somewhere before you go to more general angel groups. But as an example, if you're doing something in life sciences, where you want to build a base of patient investors that are also knowledgeable in what you do, you might go out and get a bunch of MD doctors to invest. MD doctors are not great in every deal, but in a deal in life sciences, they can be really great.
Right.
They're going to be more patient. They're going to understand the landscape and the space that you're working in. They're going to have contacts, all that kind of stuff. So that subject matter investor can be super strategic. And they can also, typically, if you select them well, they can be more patient, right? They're not going to, sophisticated angel investors and VCs, you're on their treadmill and they're going to be driving you towards some type of event because that's how they stay in the game. Somebody like doctors, or even if you're in the retail space, for example, or you're doing some kind of technology aimed at large enterprise, getting people that have built and exited those companies that can be strategic and opening doors, super smart thing to do. I call that the SME round sometimes, and it fits sort of in between the triple F round and angels. Get them there. And there are also people, again, that are going to look at it and understand the problem that you're trying to solve and aspects of what it's going to take to execute on, and they can add real value.
Yeah.
Super smart thing to do.
That's what I had kind of figured with a lot of the folks that we work with, because, it helps, like I said, maybe bridge a little bit of that, finding people that do want to invest outside of just kind of that friends and family that care about you as a founder, but they're starting to say, okay, we really care about this solution. But also, I've seen some of these strategic advisors when it's done, or strategic investors when it's done well, they can actually open some doors to revenue that then lead you down that path to true venture capital. But also, I know that sometimes people will claim to be strategic and then they're way too involved or not involved enough. So it can always be, you got to do good due diligence as a founder as well.
Well, and it's a balance too. It needs to be sort of an interview process. There are some people that would fall into that category that are only going to be happy if they're really hands-on.
Yeah.
So it's a balance between, do you really want to be married to these people and have them think that they have to drive the business? Or can they truly be advisory and helpful when you need them, but not annoying?
Yeah.
Excuse me. Well, we like to wrap it up most episodes about going back in time, giving your younger self advice. But I'm going to switch it up a little bit. I'm going to have you go back in time. Can you share an example of a deal that you should have maybe invested in that you didn't invest in?
Yeah.
You don't have to name any company names?
No. I mean, so this is funny. This is kind of a funny one. We had an opportunity, or we at least had access to having an opportunity about 2 years ago, maybe 2.5, to get involved in a rather big round in a little company called SpaceX at a valuation that seemed outrageous at the time, but which is at about 5% of where they went public. So that's one that we missed. We actually just shot that email around. That was one where it's like, well, that was probably one we should have done something with.
Yeah.
Now, at the time, it's like, well, what do we know about it? And the valuation seems crazy. And, even though we love the company and we think Elon Musk is great, probably not a great fit, but that would be a good example.
That's a great example.
Yeah. And there's probably plenty others. Jim Getz spoke during the Heartland Challenge here a couple of years ago. He's one of the senior guys with Sequoia. And they have a wall of shame out in their firm of all the things they wish they invested in that they didn't, where they missed. I never really looked at it like that. I mean, there's also a big list of things. It's like, why the hell did we invest in that? I mean, we underestimated the difficulty of the problem, or we really didn't go deep enough on the team. Teams are everything in these. We didn't do a good enough job assessing, do they have the right stuff to be successful? We have kind of more of those than the ones where we feel like we missed.
Yeah.
Because you're not going to get everything,
Yeah, I didn't want to share any of that.
So it's a balance.
Yeah, I didn't know if you wanted to share any
But
of
the
that.
SpaceX was a good one.
Yeah, that's a great one.
Yeah,
right there.
that's a good one.
Well, if there are any founders out there who want to learn more about venture capital or just fundraising in general, what advice would you give them?
Come to the Startup Junkie crew, right? I mean, we've got a lot of people that are knowledgeable. Just you go on startupjunkie.org, seek out any of us, and we can provide advice and guidance and tools and all that. I would also say, if you're interested in pitching and you're fairly early, but you have something together, look at things like the Archangel Alliance and 412 Angels if you're in this state. And if you're elsewhere, go to the Angel Capital Association, their site, and you can see there's listings of angel groups all over the country.
Yeah, that's great advice.
Yeah, man.
Sweet. Well, thank you so much for coming in.
Thanks for having me on.
Answer all the
It's
questions.
Been a minute. Glad to be back on.
Yeah. Also, thank you for co-hosting, Grace.
Of course.
And
Anytime.
then thank you to our audience for subscribing to the Startup Junkie podcast on YouTube, Spotify, and Apple.
If you enjoyed this episode, make sure to share with a friend. Subscribe and review because it matters to us and we want to hear from you. If you're interested in learning how to work with us, check out the information below. See you next week.